Hello, good day. Selamat Hari Raya. Today I'm going to talk about one of the famous theories in technical analysis, the Dow Theory. This theory lays the basic foundation for modern-day technical analysis. Many practitioners still regard the basic application of Dow Theory as one of the most reliable approaches in determining and confirming the existence of a trend. The Dow theory has also significantly impacted the way investors participate in the market more than a century after its introduction. At the end of this learning session, it is hoped that students will be able to understand the basic concept of Dow theory as well as to apply the concepts of Dow theory to forecast potential entry and exit points in the market. Stay tuned and let's learn together. What is Dow theory? The Dow theory is the most well-known theory explaining price trends. It is generally used to explain the overall market, although it can be used to explain securities and indexes. Let's learn further. The Dow theory is named after its creator, Charles Dow, the founder of Dow Jones Company and the editor of the Wall Street Journal. Charles Dow is credited for much of the early work that led to what is known today as Dow theory. As a reporter and journalist, Charles Dow wrote editorials that were published in the Wall Street Journal in which he presented his theories on predictive analysis of the stock market. Many of today's more technically sophisticated methods are essentially variants of Dow's approach. Charles Dow never formally organized his theories into a cogent whole and never wrote a book on his findings. In 1902, the term Dow theory was coined by author A. C. Nelson, who organized Dow's Wall Street Journal editorials into a book called The ABC of Stock Speculation around the time of Dow's death. In 1922, William Peter Hamilton, who became publisher of the Wall Street Journal after Dow's passing, based his book The Stock Market Barometer on Dow's tenets. In 1932, Robert Real further refined this concept in his book The Dow Theory, an explanation of its development and an attempt to define its usefulness as an aid to speculation. What is a trend? The definition by Ponzi is interesting. According to him, an uptrend consists of a series of higher highs and higher lows, while a downtrend consists of a series of lower highs and lower lows. I hope you can understand the meaning behind the words. If not, let's visualize from the figure below. According to the Dow theory, the market has three trends. The three trends are named differently in different textbooks. I hereby list the three trends. The Dow theory explains the market in terms of three trends. Let's learn further about the three trends. Primary trends are the long-run movements of prices. They are commonly referred to as bull and bear markets and are explained by fundamental economic factors. Secondary trends are caused by short-term deviations from the primary trend. These deviations are eliminated via corrections when prices revert back to trend values. A secondary trend can be described as a counter trend, corrective movement within the primary trend. Minor trends are the short-run or day-to-day trends. They are random, they are devoid of meaning. They are generally considered to be of little importance, although their movement could provide signals for changes in intermediate trends. Charles Dow describes stock prices as moving in trends analogous to the movement of water. He postulated three types of price movements over time. First, major trends are like tides in the ocean. Second, intermediate trends resemble waves. And third, short-run movements are like ripples. Followers of the Dow theory attempt to detect the direction of the major price trend or tide, recognizing that intermediate movements or waves may occasionally move in the opposite direction. How can we make use of this concept? Well, we shall recognize that a major market at once does not go straight up, but rather includes small price declines as some investors decide to take profits. From the time frame perspective, the major trend ranges from 1 year to many years. The major trend is measured in years. The intermediate trend lasts from many weeks to several months. The minor trend is about a week to several weeks. Let's have a quick quiz. In this figure, which line represents the primary trend? Blue, red, or green? I'm sure you know the answer. I have a question for you. Which trend is of the greatest concern? According to the Dow theory, the primary trend is of the greatest concern and presents the greatest opportunities. The secondary trend also creates trading opportunities, while the minor trend is usually of little consequence. In Dow theory, volume has to confirm the trend. This means volume has to increase or expand in the direction of the existing trend. If volume does not expand in the direction of the existing trend, then this is seen as a sign of weakness in the trend and may potentially lead to a weakening or reversal of the existing trend. It should be noted also that volume is considered to be a secondary indicator. In an uptrend, volume should be increasing. In an uptrend, volume should be decreasing during a downside retracement. In a downtrend, volume should be increasing. In a downtrend, volume should be decreasing during an upside retracement. If any of the four conditions listed is not met, the existing trend may be potentially weaker than expected and may lead to a reversal in the existing trend. Let's learn how to interpret volume in the direction of trends. This figure shows the movement of gold prices. The gold prices have experienced a primary bull trend, followed by a retracement in an uptrend. In area A, Volume has expanded in the direction of the primary bull trend. In area B, volume has declined during the retracement phase. This is essentially a bullish indication for gold price. So, one can expect more upside moves in gold prices over the long term. There are three phases in a primary bull trend. Accumulation refers to buying by those in the know. Often, this occurs after a market suffers sharp losses and at a time when the general public has no desire to participate. Trend refers to the period when the public participation phase begins. It happens after a market has been rising for some time. A trend occurs when the general population recognizes the existence of a bull market and decides to begin buying. Distribution begins to occur as the bull market matures. This phase is often marked by wildly bullish sentiment, widespread public interest in the markets, and conspicuous representations of the bull market on magazine covers, television, or media. Let's look into an example on how to identify accumulation, trend, and distribution phase. This figure shows a real-world example of a primary bull trend. Accumulation occurs when the stock prices are low. This is followed by a strong breakout or trend. Subsequently, stock prices reach the distribution phase. Stock prices are higher at the distribution phase. To master this skill, I will teach you more technical analysis tools such as support and resistance in my upcoming videos. Hopefully, stay tuned. Finally, we have come to the end of this video. I hope you have learned some knowledge from this video. If you like this video, please click like, share or subscribe to my YouTube channel. Thank you. See you and goodbye.